The stock market is in turmoil, and panic is spreading like wildfire. Headlines scream about an impending disaster, social media is buzzing with fear, and everyone seems to be asking the same question: should I sell now before things get worse? But before you let fear take over, let's pause and look at the bigger picture. As someone who's been deeply invested in the stock market for years and has guided many of you to start investing, I feel a responsibility to share my honest perspective on what's happening. This isn't just noise, there's a real story behind the market's chaos, and it's tied to three key triggers, all linked to one figure, Donald Trump. This isn't about politics. It's about understanding what's driving this market crash and how you can navigate it to come out stronger. Let's break down these triggers, why they matter, and how you can position yourself to benefit from the mayhem. First, let's talk about Trump's trade policies. He's always presented himself as a deal maker, someone who fights for American jobs and isn't afraid to play hardball with other countries. His approach involves imposing tariff taxes on imported goods to protect American businesses. But these tariffs could have serious consequences, potentially increasing the cost of your weekly grocery bill and even pushing the economy toward a recession. History offers a stark warning here. In 1930, the U.S. government passed the Smoot-Hawley Tariff Act, which slapped massive tariffs on imported goods to shield American companies from foreign competition. The idea was simple: make foreign products more expensive so American businesses could thrive. But it backfired spectacularly. Other countries retaliated with their own tariffs, making it harder for American companies to sell goods overseas. Global trade slowed to a crawl, businesses collapsed, and millions lost their jobs. What started as a plan to protect the economy turned a manageable recession into the Great Depression, one of the worst financial crises in history. Fast forward to 2025, and we're seeing echoes of this past. In February 2025, Trump announced a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. Canada didn't sit idly by. It hit back with a 25% tariff on American imports. Then, in March, Ontario added a 25% surcharge on electricity exports to the U.S., affecting states like New York, Michigan, and Minnesota. While this move was largely symbolic and unlikely to cause major damage, Trump escalated the situation by raising tariffs on Canadian steel and aluminum to 50%. This wasn't just posturing, it hit Canada's manufacturing sector hard and drove up steel prices for American businesses that rely on imports. The ripple effects are significant. Tariffs sound appealing because they're meant to protect local industries, but they often hurt consumers the most. As a business owner who manufactures products and imports from China, I've seen this firsthand. When businesses face higher costs for materials, they don't absorb those costs, they pass them on to customers. That means higher prices for cars, appliances, electronics, and even food as supply chains get disrupted. Your household budget gets stretched thinner, and everyday essentials become more expensive. But it's not just about higher prices. Other countries aren't standing still while the U.S. raises tariffs. They're forming new trade alliances to bypass the U.S. entirely. China, for instance, is strengthening the BRICS alliance with Brazil, Russia, India, and South Africa to reduce dependence on American trade. The more the U.S. isolates itself, the more other nations turn to alternative partners. This could weaken America's position in global trade over time. From my perspective as an experienced investor, if Trump doubles down on this trade war, history suggests it could do more harm than good. While some industries might see short-term gains, the long-term consequences, higher prices, strained global relationships, and a slower U.S. economy could outweigh any benefits. But here's where it gets interesting. I don't believe Trump genuinely wants high tariffs. As a businessman and deal maker, I think he's using tariffs as a negotiation tactic to push for a free global trade on terms that favor the U.S. If he pulls that off, it could be a game changer. However, his approach is creating massive uncertainty. The constant policy shifts, new tariffs, and mixed signals are spooking investors who hate unpredictability. This uncertainty is shaking market confidence, and if it continues, it could push the economy closer to a recession, something even Trump's administration has acknowledged they're willing to risk. The second trigger is Trump's stance on NATO. He's openly questioned the value of the military alliance that has long protected Western nations, arguing that the U.S. shouldn't bear the cost of defending allies unless they pay more for their own protection. On the surface, this might seem reasonable, but pulling back from NATO could create a power vacuum that countries like Russia or China might exploit. Markets thrive on stability, and any hint of global instability sends investors into a panic. If NATO weakens, it could embolden Russia to push further into Europe or spark new conflicts as nations adjust to a world without the U.S. as the global police force. Conflicts drive up military spending, disrupt trade relationships, and cause energy prices to spike, all of which rattle the stock market. The uncertainty surrounding NATO's future is another layer of risk fueling the current market turmoil. The third trigger is a theory that might sound far-fetched, but has some evidence behind it. Trump may be intentionally crashing the stock market. He's been vocal about his dislike for high interest rates, calling them ridiculous and criticizing the Federal Reserve for keeping them elevated. The Fed operates independently, so Trump can't directly order them to lower rates. However, their decisions are influenced by economic conditions. If the stock market crashes and a recession looms, the Fed would likely have no choice but to cut interest rates to prevent a total economic meltdown. Why does Trump want lower rates? High interest rates slow economic growth, businesses borrow less, stocks struggle, and consumers spend less. For Trump, who prioritizes growth and projects an image of strength, high rates are a problem. But there's a bigger issue at play: the U.S. government's staggering $36.5 trillion debt. High interest rates make servicing that debt incredibly expensive. Think of it like a credit card bill. If you owe $36,500 and your credit card charges 10% interest, you're paying $3,650 a year just in interest. If the rate drops to 3%, your interest falls to $1,095, saving you $2,555 annually. On a $36.5 trillion scale, lower rates could save the government billions, if not trillions, in interest payments. If Trump is deliberately creating conditions for a market crash to force the Fed's hand, it could be a calculated move to refinance the nation's debt at a lower cost. If true, this wouldn't signal a long-term economic collapse, but rather a temporary shakeup before a potential rebound. So, how can you navigate this chaos and come out ahead? Stock market crashes aren't rare disasters, they're a normal part of investing. Every few years, the market takes a hit, headlines scream doom, and panic sets in. But history shows that every crash in the U.S. market has been followed by a recovery. Those who panic and sell often lose money, while those who stay calm and invest strategically come out on top. Instead of fearing the market, this is the time to prepare, make smart moves, and position yourself for gains when the market rebounds. I'm not a financial advisor, but I've made millions during market crashes, and here's how you can approach this opportunity. First, focus on investing while the market is down, but only if you have a solid financial foundation. This means having an emergency fund with 3 to 6 months worth of living expenses and paying off any debt with an interest rate above 8%. If you've got that covered, a market crash can be one of the best times to start investing. Stocks are essentially on sale during downturns. In the 2008 financial crisis, I invested at the bottom and saw my portfolio double within a few years. Friends who panicked and sold locked in their losses and missed the recovery. Timing the exact bottom is impossible, but investing consistently while prices are low lets you buy assets at a discount. If you're new to investing, platforms like Trading 212 are offering incentives, such as a free fractional share worth up to £100 when you use a specific code and fund your account. Check the description for details if you're interested. SS.